We're back here now, and the R word is here. That's right. Yesterday's announcement, GDP dropped for the second quarter in a row, brings the country into a technical recession. So, what does that mean for you? Infometrics principal economist Brad Olsen joins us to discuss this live from Hamilton this morning. Morning, Brad.
Good morning.
Brad, what does this mean for you? What are the concerning factors coming out of the latest data?
Well, and I think this is interesting because normally when we hit a recession, economic conditions do feel a lot worse than this. In fact, you'd normally be talking about businesses that are looking to shed jobs and a lot more challenges across the way. In fact, we saw employment growth of 2.3% over the first 4 months of 2023. And I think that's the reason that we're talking about a technical recession a lot more this time, because conditions don't feel like people might imagine a recession might come through as. But let's be clear, we have seen 2 quarters in a row where economic activity has fallen, down 0.7% back in the December 2022 quarter. The first 3 months of 2023, we saw a decline of 0.06%. That's where you get the official 0.1% down. But I think it is important to note that was by a fairly slim margin. Economic activity still a whole percentage point larger, roughly, than what it was in mid-2022. But we are very much seeing the results of what the Reserve Bank has been trying to do. We were told last year that spending needed to be cut. We were told that a recession was being put together to try and bring inflation under control. And the Reserve Bank seems to have sort of hit that one right on the head. It's got a bullseye, but at the same time, not the same sort of recession conditions that we saw during the global financial crisis or even during COVID lockdowns.
Brad, you have been at field days all week. The stats suggested that household spending is down. Have you noticed that spending is down at field days as well, just as an example?
Yeah, absolutely. I think a lot more people have been sort of window shopping rather than actually shopping and getting out the checkbooks. There has and is always going to be an underlying level of spending. A few people I talked to had bought, expensive tractors and similar, but a lot more people are a little bit more guarded about their money, and that's coming through in the official numbers too. We saw that household spending fell 0.2%. Outside of lockdowns, that's the first annual decline in spending that we've seen since 2009. And when we dig into the details, you do start to get the feeling that households really are starting to come under a lot of pressure. Again, a bit different, though, from the last time that pressure came on. Back in 2009, and when the GFC started to come through, people were losing jobs. They didn't have as much money, therefore they couldn't buy as much. This time around, lots of people have got jobs, but their mortgage rates have increased, and so they're not able to spend quite as much. And we've seen the likes of durable, long-lasting goods. Spending on those has fallen 11% over the last year. That's the worst result since 1990, excluding lockdowns. And when we go and look at non-durable, sort of more consumable, quick-fire goods, they've fallen 6% over the last year. That's the largest fall on record, excluding lockdowns. And so you really do get the feeling that this time last year we were spending a lot more. The economy was running incredibly hot, in fact, too hot for us to maintain. We've been living beyond our means. Now those interest rates have gone up. Now the Reserve Bank is trying to get inflation under control, and households are having to respond appropriately.
Right, as you mentioned, Reserve Bank have been trying to do this on purpose to get those interest rates under control. Has the economy slowed enough, or have we slowed enough for those interest rates to stop and prevent further hikes?
Not yet, but I think importantly we're on the right path, and that's broadly where the Reserve Bank's thinking has moved to as well. When they met at the end of May, their view was that they had done enough at that point to try and bring inflation under control. They just needed to let their interest rate increases work their way through the system. We know there's still about half of all of the mortgages in New Zealand that needs to refix onto a higher mortgage rate this year. So those continued pressures on household budgets will evolve throughout 2023 and into 2024. And certainly at the moment, you get the feeling that we're on a better path to getting inflation back under control. We're under no illusions that we're done yet, though. We've managed to get inflation back from a 7% or plus inflation rate down to 6.7 in the last quarter. We're looking to get between 1 and 3. So it will take some time to come back, but certainly an expectation that we're starting to move in the right direction. Households aren't able to spend as much, and increasingly that means that businesses won't be seeing as strong of sales volumes, and they'll be much more reluctant to push price increases on. All of that is expected to bring some of those inflationary pressures back in check.
Some tough times ahead. That's Infometrics Principal Economist Brad Olsen. Thanks so much for your time this morning, and enjoy the last few days of Field Days.